With a changing market, investing success requires a clear strategy and a track record of performance. If you're serious about building a property portfolio, you need to speak with Lachlan Vidler and his team at Atlas Property Group. As a national finalist for 2022 Buyer's Agent of the Year, Lachlan and his team are ready to build and scale your portfolio in any market. Whether it's financial freedom or a more secure future, Atlas Property Group is here to guide and support your personalised journey. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Okay, hey gang, Phil Tarrant here, host of the Smart Property Investment Show. I hope you're well. Hopefully picked yourself off the floor. We had another rate rise announced a little bit earlier this week. Most of you I know are in tune with this rising rate cycle that we're in right now. Get used to it. I think there's a few more to come. Plenty of economic commentators out there giving some sense of what's happening. A lot of them outside of Australia, and I'll tell you one thing, but there's some smart people I know inside of Australia who are giving good sense of this market. Yes, it's an inflationary cycle right now, which is driving up a lot of prices in Australia. Yes, there's a war in Ukraine that's causing many problems connected in with inflation. A lot of the problems that we have in terms of increases to property markets is around construction costs. We all know about that. We've been talking about it at length. All of this sort of stuff's lending itself to the RBA trying to get the brakes on the economy, trying to reshape it so it can reset and move on moving forward. The mail I'm getting is that a few more rate rises happen this year, 50 basis points, and then we'll probably see the brakes applied and a bit of a breathing space to see what happens. But, there is indications that rates will come down. Some commentators out of the US are actually talking about that happening in America, and we typically follow suit there. But anyway, this is not an economics lesson. There's plenty of other people smarter than me around it. But this is going to start shaping and forming the way in which you buy, invest in property, and also potentially support those around you to capitalise on property as a wealth creation tool. And I've spoken at length, and I've had many people on this show about getting started in property and how hard it is, particularly raising the deposit. A lot of people can service a mortgage. That's obviously changing. Serviceability levels are being shaped by these rising interest rates, and what you buy may be different and where you buy it may be different. But the same thing applies in that to get going in property investment, you need a deposit. And how do you go get a deposit when you're paying rent and all the other stuff? As if you're younger, it's pretty hard. But there's products out there that can help you out with that. And we're going to get into that a little bit today, later in the podcast. But the guest I have with us today to chat through things like that is also someone you've probably heard his name before. He was once upon a time, maybe it's the case that once a banker, always a banker, but once upon a time a senior banker in Australia at Westpac, Brian Hartzer. He joins me in the studio. He's the chairman of 2B, which is a home equity loan provider. We're going to have a chat about that and how it might be an enabler for not only yourself to get into the property market, but you may actually be able to kickstart your kids into properties. Really smart product. I've been learning about it over the last couple of weeks. I like it. I think it's got huge relevance in this market, especially as it gets harder to enter the property market. But I want to chat about a whole bunch of other stuff as well. Brian, welcome to the show.
Oh, thanks for having me, Phil. It's great to be here.
So you're quite comfortable around podcasting.
Done a little bit of it.
You know, a fair bit of radio work in your time, no doubt.
I have had to do a bit of that,
getting grilled by
yes.
pesky journalists asking about earning results.
I don't miss that.
You don't miss that stuff at all. But look, you're obviously still highly connected and informed around what's happening within banking circles in Australia. And I think we're very fortunate, and it's a lesson that we all learned through the GFC about the strength of the Australian banking system. We did pretty well through that. And even today, we look at our banks. They're exemplar for many nations worldwide about how they operate and are that tool of utility for wealth creation for Australians. We all own bank shares somehow, so we all want a strong banking sector through our superannuation funds, but they also lend us money, which is a good thing. Dispel a myth for me.
Sure.
Because a lot of people get this wrong. They think that banks don't like lending you money because they make it so hard to actually get a home loan.
It's such a good one. I'm so glad you start with that. I used to always say to people, how do you think banks make money? They lend. This is actually how they make money. They absolutely want to lend. Yeah. But, we've had a really tough 10 years of active regulation that has made the process for banks really, really complicated. And the banks themselves don't really like it, but it's just been the consequence of regulators trying to make sure that nothing can ever go wrong. And as a consequence, lots and lots and lots of rules about how much capital you have to hold, how you have to validate people's expenses, all these sorts of things, which has made the process really quite complicated and also meant that anything that was a bit outside the box has been very difficult for banks. And so unfortunately, a lot of things have ended up in the bank's too hard basket. And that's certainly something we've been trying to address for one aspect of that. But to go back to your point, banks want to lend.
They love to lend.
They love to lend. That's what they do.
And I always say that a lot of the value in banks' balance sheets is their mortgages
Absolutely.
business. And
Yeah.
that's absolutely true.
And that's become more and more true over the last few years because of the way the capital rules have changed. So banks have to hold a certain amount of capital depending on what kind of loan that you have. And the way that has changed over the last couple of years is to really push banks towards holding more mortgages relative to other sorts of loans. And so they are now, the big banks, largely big mortgage companies.
And if you think banks are making it hard for you to borrow money, they're not deliberately doing it. To Brian's point, they've got to play within the rules, and the rules are set by a number of different people. We don't need to go into them, but you got to play by the rules. So the banks don't necessarily make it difficult. They're just playing by the rules and make sure that there's a certain sense of conformity to how you borrow money.
Yeah, I would say, though, in fairness to people who get frustrated, rightly so, I think also the banks have become very gun-shy about negative publicity, about regulatory action. And so you have the rules, and then you've got banks essentially putting some internal buffers on to make sure that they don't accidentally go outside the rules because they don't want to end up in court. They don't want to end up in a bad media article. And so I think there's a bit of an overreaction, and they are a bit overly conservative because they've become a bit gun-shy because the publicity on banks has obviously been so bad over the last few years. And banks, I know it's hard to believe at times, but most bankers are human beings somewhere under there. And they don't want that negative publicity. They don't want to be seen as doing the wrong thing.
Yeah.
But unfortunately, the consequence of that is people who should be able to borrow sometimes can't.
Yeah, and this is the environment. Obviously, we're in a rising rate environment, and we've had a number of increases over the last couple of months, and largely expected. A lot of the rhetoric that I've been hearing from people is there's a lot of annoyed people, pissed off people, thinking that the RBA weren't going to rise rates until 2024, and here they start happening sort of the early part of 2022. So there's some people out of their depth and sort of scratching their heads going, well, hang on a second, like, are we going to be okay here? But there's lots you can do, right, if you own a mortgage to mitigate some of the stresses around that.
Yeah. Well, to your point, I think it's understandable that people were a bit surprised because the RBA had been very transparent, and a lot of economists and commentators have been saying for a long time that they were not expecting to raise rates. And so it has been a very significant change. In their defense, I think everybody was caught a bit surprised by the way inflation has picked up as a consequence of COVID-related supply chain interruptions. We got a war in the Ukraine, obviously, which is affecting in particular energy prices. And the other one that's a big one, I think, for Australia is China's got this zero COVID policy, which means they keep locking down, which is then messing around with how trade in and out of China is affected. And so I sort of think of this as if you imagine you've got a pond and you chuck a bunch of rocks into it, it suddenly gets very bouncy in a few areas for a period of time until it settles down. And I think it's kind of what's happened to the world economy.
Yeah, and it sounds as though it is settling in some areas. You know, some of the costs of goods are starting to come down.
Yeah. I mean, there's been some good data, particularly out of the U.S., about some of the costs starting to come down. But there's still a ways to go, and there's still some real uncertainty, particularly energy prices and the like.
Yeah, and take me back to your time steering Westpac Bank as Chief Executive Officer. It's a big job, right? It's one of the big jobs in Australia.
It's a pretty big job, yeah.
It's a pretty big job. What did a normal day look like for you? Imagine it was like, was it just stakeholder engagement most of the time, just keeping things on track?
Well, I think that it's a bit of a cheat, but I'd say there weren't that many standard days. It was more there was a rhythm to it during the year. There were certain things you did at different times of the year. But it was a combination. Certainly in the last couple of years, I probably spent 60% of my time on some sort of governance-related activity, whether it was dealing with regulators or sitting in some sort of risk committee or, reviewing the progress on some remediation program or whatever it was. Spent a reasonable chunk of time visiting customers and external engagement. A lot of the job is about external engagement, so you do a fair amount of that. And then at different times of the year, you're doing strategy, goal setting, reviewing projects, coaching people, a lot of getting out and communicating to staff, which was the bit I really enjoyed. But, in some ways, of course, it is an enormous job. And the biggest challenge is you have so much variety and you have to be across so many different things, which I found incredibly stimulating, but also pretty exhausting. You get home sometimes and just want to stare at at a blank wall. But I guess the other thing, though, is in some respects, it's like any management job that you're managing a group of people. And those people all have big responsibilities. But in some sense, it's not that different from managing any team of 8 or 10 people who've each got their various responsibilities. They need to be brought together to work as a team. You need to have common goals. You just have a very, very big leadership shadow and a lot, obviously the old cliches about moving a big ship around, it takes time. And, you can't know everything that every last person is doing, but you're on the hook for all of it. And, But, I would just say it was an incredible privilege. I mean, it's a great company and I really enjoyed it.
Yeah, I've banked with Westpac for 25, 30 years. So I'm a happy customer. It's okay. But give me a sense for rate day. So, first Tuesday of every month when the RBA gets together and everyone most people know what's sort of going to happen, right? Everyone sits around, our listeners, they sit around and go, okay, what's going to happen with these rates? And they've probably already got their calculator out and done some sums and worked out how the decision is going to impact their back pocket. What would happen inside of a bank around rate day? Was it like, it's rate day, or was it like, it's rate day?
Usually there's a lead up to it. So particularly at Westpac, we have probably the preeminent economists, particularly around the RBA and interest rates in Bill Evans. So Bill would tell us what he thought was going to happen. And most of the time, frankly, he was right. But we would have some scenarios about what else might happen. Yeah. And then it's a combination of looking at the position of mortgage demand versus deposits, because you're trying to balance, a rate increase or let's say a rate decrease. A rate decrease, great for mortgage customers, not great for depositors.
Yeah.
And so you're trying to balance up what's our relative position. Essentially, banks are trying to manage to a margin between those two things. And so you're looking at the shifts in the product mix, because if you've got more interest-only loans, or you've got a mix of investment property loans, or you've got longer-term deposits or shorter-term deposits, you're trying to look at how that all works out in a kind of weighted average sense. And different banks at different times will have different priorities. So a bank that perhaps is losing market share might look at a rate change opportunity to price more aggressively. Or a bank that maybe has more deposits than it expected to have, maybe it can actually afford to take on more loans, or maybe it wants to slow down its deposits a bit because it's got more deposits than it needs. So usually you're looking at the balance sheet situation within the bank, and the interest rate is kind of a balancing mechanism of how you make –
if it's up somewhere, it's down somewhere else.
Yeah, so there's that. And then on top of that, you obviously – the banks are – probably would surprise people to know this, but in reality, the banks are fiercely competitive with each other because we're all compared against each other's performance. And so the bank – there is a competitive overlay of, okay, what do we think those guys are going to do? And if they do this, what are we going to do? And, there's this kind of scenario planning that goes on. And generally, you end up with a view that, okay, if it plays out in this way, this is what we'll do. And sometimes that means we might try to make an announcement straight away to be clear of what we're going to do. And other times we might not be as sure how the market's going to play out, and we want to wait and see what the rest of the market is doing before we respond. So each situation is a little different. So it's a combination of, it's mostly about the balance sheet and the financial position of the balance sheet at the time. And it's a little bit about competitive positioning and game theory.
Yeah, and we're going to go break in a moment because I want to get into some sense of where this market is right now and this new initiative of yours, 2B. But just to round up before we go there, can you give me some sense, what's your read on how the property market's going to sort of move forward, considering there's a sense of equilibrium in terms of stock on market and sales at the moment? I think that's sort of holding prices pretty good. A lot of commentators are pretty much saying, and a lot of banks are forecasting in negative prices in house values. A lot of commentators saying we're already down probably 3/4 of that anyway. We're nearly towards the bottom. What's your sense for it? How's the market going to move?
So can I answer that by saying, first of all, I'll take a longer term perspective on this and say that the Australian housing market is very solid and strong because fundamentally we don't have enough housing. Now, we've had a bit of a relief on that because we've had immigration slow down over the last couple of years because of COVID, but we've had this underlying driver of not enough supply relative to demand. And that's both immigration, but it's also more small family households demanding different kinds of housing units. So you've had this disconnect, which has been fundamentally driving the growth in house prices, just, basic supply and demand issue. And then you had the COVID impact and you had the stimulus that went into the economy and people then using that money to compete, to renovate and to buy homes. And what I find astonishing is over the last 2 years, if you go back to just when COVID hit, April 2020 to today, house prices across the country are up 30%. So we had 30% increase nationally. And in some cities, it's up, I think Adelaide's up 45% or something unbelievable in 2 years. I mean, this is house prices. This is an incredible increase. And so now we have rate rises. And I think we should talk about what's driving that and what the RBA is actually trying to do. But the rate rises then mathematically mean that people can't afford as big a mortgage as before. And so guess what? The prices they're willing to pay come down. And so when people talk about house prices falling, specifically what they're saying is the price of houses that are trading at a lower price because the interest rate has essentially changed the relative value of that. But what we're not seeing, and I think this is really important, is we're not seeing people suddenly feeling like they have to sell their house. This is not a people dumping properties on the market. This is that the people who are in the market to buy can't afford to pay as much as they could before. And that's a good thing when you consider property markets are not meant to go up by 30% in 2 years. You know that, I mean, it's great if they do, if you happen to own a home.
They're not supposed to.
But they're not, I mean, that's not what's meant to happen. And so I find it hard to get exercised by the alarmist headlines. And you see people going, you know, this is the biggest fall we've seen in a month in 40 years or whatever, and okay, that's true, but it's off the back of a 30% rise over 2 years. Yeah. So, I'm just struggling to get – now I feel sorry for someone who has bought a house at the top of the market. They've leveraged themselves up because they've stretched to try to afford the house they want to buy. Now their cost is going up. We have to be deeply sympathetic for people in that situation, absolutely. But for someone who happens to have bought a house a few years ago, they're still well ahead. And I think we did some research recently and said in no 5-year period in living memory have house prices gone backwards in Australia over any 5-year period.
Yeah.
So sure, if something's going to go up 30% in 2 years, you got to expect that something happens, prices are going to fall. I personally would rather see that as a good thing in that it means house prices become more affordable for the people that are trying to get on the housing ladder. And as I say, I do have sympathy for people who have borrowed a lot and now seen that go the wrong way. But, I think in the long run, they'll be okay too.
If they can hold on, they'll be okay. And there's some smart stuff coming out of the RBA around how far ahead most Australians are in their mortgages.
Yeah.
So there is this, a lot of them can buttress.
And there's another one I used to, in my old job, you'd travel around the world and you'd meet with investors and they would always say, oh my gosh, the Australian housing market is a huge bubble and it's going to blow. And I would always say, oh, I don't think so. Because the other thing that people often don't understand is for at least 7 years now, when you apply for a mortgage at a bank, the bank assumes interest rates are 2 or 3% higher than what they currently are when they assess how much you can afford to pay. So everyone who's gotten a mortgage in the last few years got it on effectively the bank assumed the rates were higher. Now, and that therefore the customer could afford a rate rise of 2 or 3% at least.
Was priced in.
Yeah, it's effectively priced in. Now, the issue is, and this is where we come back to the interest rate issue, is that what that does is it means you got to spend more of your money on housing, therefore less of your money on other things. And that is really what the RBA is after. They're trying to crimp off spending on non-housing things because they're trying to cool the economy.
Yeah, I think that's really well explained, and I've been trying to articulate that for a lot of people within this show because most people think it's countercyclical or things going up. Why are you making my mortgages even more expensive? It doesn't make sense. So you've explained that really well. But while I've got you here, and I've always thought about this, and you spoke about there the dynamics or the machinations of how prices move depending on stuff. When COVID hit, a lot of the banks, some banks were forecasting a 25-30% drop in values, and what happened was completely the opposite. How do you think the banks got that so wrong?
Well, and I have to admit, I sold a house right when COVID hit. We had some family changes and my job changed and so on, and prices fell very quickly for a period of time. So they did fall very quickly for a period of time. There was so much uncertainty. We hadn't had a pandemic in 100 years. And so no one had lived through that. No one knew what the impact of a global pandemic was going to be. And there were real legitimate concerns that it was going to seriously mess with the economy. So I guess that's not that surprising. Hindsight's a wonderful thing.
Yeah, it is.
Actually, though, here's my reflection on that point, because I've asked myself, why did I get that wrong? And what I misunderstood was, and I kicked myself because I did actually know this, I just didn't think about it, is the Australian government's capacity to spend money to keep things going was and remains quite significant.
Yeah.
So if I had thought about it hard and asked myself, what are the politicians going to do? And I would have instantly known what they're going to do is they're going to spend their way out of this, because the politicians don't want to see people losing their jobs. They don't want to see the economy going down. And so what they did is they threw money at it, colossal amounts of money at it. And that, you could say that was a really good thing, but, and it was, but it was also politicians protecting themselves, I think. And luckily, though, in their defense, the politicians in one respect and the Reserve Bank have done a very good job of managing the country's finances over the last 10 or 15 years to the point where the national debt was so low that they had the capacity to spend huge amounts of money to keep everything going.
Yeah, and I concur with all those points. But I guess the catch-all for me as Australia went through that journey and how the government responded was the Australian government has skin in the game when it comes to property in Australia. They're highly invested to make sure that we have a property market which is sustainable and scalable for the future, which no doubt gives banks a lot of confidence around lending money, which no doubt gives Australians a lot of confidence around taking on debt.
Yeah. But equally, and you said something earlier about the quality of the banking system. One thing I think people should know is the banks absolutely learned their lesson in the early 90s about credit risk and irresponsible lending. Now, so they can debate about where to draw the line, but the culture within the banks at the most senior levels is still people who remember that banks can get in a lot of trouble if they take too much risk.
Yeah.
And so we are fortunate that the banks genuinely set out to be conservative.
Well, the point is, it sounds as though in this new initiative of yours with 2B that you're still backing Australian property by sort of making facilitation around home equity loans. I want to have a chat about that. Let's go to a break beforehand. Stay with us. Back in a moment.
Throughout 2022, we've already seen a huge ebb and flow in the Australian housing market. Property prices increased earlier in the year, but the rate hikes have slowed down price growth over the last few months. Even so, we've seen more new listings hitting the market than we've experienced in recent years. Plus, with many property owners having accrued a significant increase in equity, the market is hot for investors looking to snap up another property that may have reduced in price. To help you find these properties, the team at Pure Property Investment have done all the legwork to identify the top 30 suburbs that have not only shown growth throughout this year, but are also poised for strong capital growth over the next few years. Grab your free top 30 guide to property investment guide today at www.purepropertyinvestment.com.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show. I'm with Brian Hartz. He's the chairman of 2B. So, Brian, tell me about this journey. You've gone from running one of the largest sort of companies in the land to, I guess, being a small to medium business owner.
Yes.
How are you finding it?
I'm loving it.
Yeah.
I'm really loving it. I've always had the thing that was great about working in a bank is the exposure to business and all the different businesses. And I've always had an entrepreneurial bent and been particularly interested in consumer service businesses. And we spotted an opportunity we've been talking about regulation earlier in the show, and it became obvious to me that one of the unintended consequences of the increases in regulation was that the banks had effectively stopped lending money to people over 55, because the regulators and the banks have interpreted the regulation to mean that unless you can service the loan out of your income and your salary going forward, that therefore that was by definition an irresponsible loan. Regardless of your asset position, regardless of how much equity you had in your home, regardless of how many investment properties you had or shares or whatever it might be. And my co-founder and I just thought that was crazy, that people over 55 who have worked all this time, paid off their house, are by any stretch wealthy, should be able to enjoy this phase of their life. And if that means having access to a debt facility to help their kids onto the property ladder, to renovate their home, to take the trip of a lifetime, if that's what they want to do, they should be able to do it. Provided, we believe you should treat people like adults and give them the ability to use their assets as they see fit. And so we just felt that there was this enormous opportunity opening up. There's 5.5 million people in the baby boom generation in Australia, and they've collectively got over $2 trillion of equity in their homes. And the banks have said, sorry, you're too old. We don't want to lend to you. And that just seemed crazy to me. And so we went and had a good look at the regulation and the products that were out there and decided there was a way to at least help some of those people to enjoy their lives a bit more. We call the business To Be, as in to be or not to be. And we think that now's the time to be. If you're in that phase of life, now's the time to enjoy what you've built up. And hopefully people will find this helpful.
Yeah, and for this audience, I guess there's two sides of the coin, and probably relevant to be. We have a lot of people who are wealthy property investors, and it's this idea that property investors are mega wealthy. I think as we went through that last election when Labor tried to get up and they tried to paint property investors as all rich and powerful, they worked out they're doctors, they're nurses, they're good Aussies who've been working hard all their lives, right?
Absolutely.
And they want to help out. They want to help out the next generation. So we have a big cohort of those people tuning into this who may be sitting on a lot of equity and at the sort of the other side of their property investment journey, they might be selling down or looking to realise those values, those assets. On the other side, we have a lot of young property investors who are itching to get into the game,
right.
But they can't because they can't raise a deposit. So no doubt they could start sort of giving their mum and dad a bit of a nudge going, hey, there is actually stuff now to be that can help me do that without an enormous amount of risk at their end and over leveraging them. So it's a really balanced equation. As you've launched To Be, where's been a sort of major focus for you? Has it been at trying to communicate and educate to those people who are sitting on these assets that, hey, you can actually get this debt facility, you can use it as the bank of mum and dad. Here's a very formal, a very governed way to use it as the bank of mum and dad. Or you know what? You can fix your house up. You put a new roof. You put a new level on it for the grandkids. So you can do all that sort of stuff. Where's the appetite been? Yeah,
well, it's all those things. I'd say one thing we've really focused on is, as you alluded to, is education. And we've thought about this really as a family proposition in the sense that if you think about taking advantage of the equity you've built up to help your kids, you're actually making the family balance sheet stronger because rather than the kids waiting 8 to 10 years to save up enough for a deposit and continuing to pay rent, or taking out a really low deposit loan where they have to pay lender's mortgage insurance, and so a lot of the cost is going into that, the parents who are sitting on this house that they've paid off can use some of the equity to help the kids with that deposit. If they've got a good job, they can afford the mortgage. And in 5 years' time, the value of both properties has gone up. The kids can refinance and pay back the parents if that's what they want to do. And everyone is essentially better off. And to your point, the reason we've focused a lot on this bank of mom and dad thing is the research said that the number one thing that people in that generation wanted to do was find a way to help their kids. And so we put a lot of emphasis into education. There's a lot of free material on our website about the things you need to watch out for, because a lot of parents are doing this already, but not documenting it properly. Yeah. And then you find maybe they've given their kids a gift and then the kid's marriage breaks up, unfortunately, and half the money suddenly disappears. And the parents think, wait a minute, how
it can get messy.
Right? It can get very messy.
Yeah, it can be messy.
Or you can end up with the kids get into financial difficulty. They've gotten a parental guarantee. All of a sudden the parent's house is at risk because of the kids, and you've got a bank involved, and you end up with both a family breakdown as well as a financial problem. So making sure that you don't get in over your head, that you think things through. So we put some calculators on there to help people think about what they can actually afford and all that sort of stuff. But to your point, for a lot of these people, we think if they want to use the money to renovate, stay in, we think over time, age in place is a big theme for the government. I think this can be part of the solution to that. But, this is a great time for people to enjoy what they've built up.
Yeah, I can see the utility. I think it has huge utility. And I hadn't really thought about the way you framed it, whereas what you're doing is collectively growing a family's balance sheet.
Yeah.
And what happens with families is typically continuity of wealth goes down through generations. Some people are able to sort of capitalize on that before the parents choose to depart this great world. And I know a lot of people are now doing that, but actually have the mechanism to do it. It is around education. It's about doing everything right at the front end so it's not as painful at the back end. And there shouldn't be a painful experience if you get the front end right. But for me, it's all about the speed of getting someone into property early.
Yeah.
And we speak about a lot on the Smart Property Investment Show. Everyone always asks me, Phil, when's the best time to buy a home? Or Phil, I shouldn't be buying now because the market's tough. And I go, buy when you can. Like
Absolutely.
It's to your point, property hasn't really gone backwards over a 5-year period for, as long as the records have.
Yeah.
There might be some blips there, that's general. But the sooner you can get in, the better.
Well, we've just put a new calculator, we call it the kids calculator internally, on our website, which is tobe.com.au, where you can go in and you can put in the amount of the house you want to buy and how old you are and these sorts of things. And it's focused on showing the kids and the parents the difference between trying to save up to buy that house versus getting on the property ladder now, taking advantage of the first home buyer grants that are available, and how much better off you both are in 5 years' time if you buy now versus waiting 5 years to buy. And it's quite compelling, as you say.
I imagine you had some pretty smart boffin work that out because a lot of inputs had been set.
It was,
that.
yeah, and we had to really understand how the different programs work in the different states because each state's got its own grants and stamp duty issues and credits and all these sorts of things, and so it incorporates all of that. But it really does make a pretty compelling argument. And the other thing is that at the moment, for a lot of parents in this generation, it's binary. You're basically faced with this choice of I either have to sell my house or sell my investment property to help my kids, or I can't help them and I have to just sit here in this house until I die or eventually want to sell. And what we're really doing is giving people an option that says you can actually get started now. You can get on the property ladder now if the parents, and it all needs to be discussed and it needs to be the right thing for the family. And you need to think about if you've got multiple children, how you're going to make sure how you deal with that. And there's a lot of things to think through on this. But it means that we're giving people who can afford it an option that many of them just don't have right now.
And I find it intriguing that you've chosen to do this. And I would imagine, you hang up your boots at Westpac, there would have been a number of different pathways. You could have gone a nice job in government somewhere and done this sort of stuff. But you've chosen to do this. So you must have a passion for the outcome that you can create by enabling people to do this. You can sort of see it in the way you talk about it.
Yeah, it's interesting. So I worked at ANZ for many years, and when I was at ANZ, we had a reverse mortgage business, which we shut down because it was having too many compliance and media issues. I shut it down at the Royal Bank of Scotland when I was over in the UK for a couple of years, and shut it down, frankly, at Westpac as well because we just couldn't make it work. But it really frustrated me because I could see that there was a need. And I could see that over time that need was going to grow as the baby boomer generation ages and as more people are trying to get onto the property ladder while prices are going up. And it just bothered me. And so when I had time on my hands, I started really looking at where were the big waves that were coming, where were the big opportunities. And this one just kept nagging at me that, there had to be a way to do this. And fortunately, I've got some great colleagues. My co-founder, Dr. Jenny Fagg, has a PhD in credit risk and for a period of time was the head of risk at AMP and CEO of ANZ New Zealand. And she's just a guru when it comes to regulation and credit risk. And we just put our minds to it and found a way through it. Yeah.
Well, it sounds like a good team and you got some bright people behind the organization. I look forward to watching it grow. But it must have been a bit of a eureka moment where you could sort of, this inherent philosophy you had around this has to work, but sort of uncovering the piece of legislation that allowed you to go, this actually can facilitate this. It's there and it's set. Probably needs some tweaks, no doubt.
Yeah.
But there is something there that the mechanics are there in order to provide this product to Australian consumers. How does it, I don't want to go too technical.
Sure.
But I know we've got a lot of technical people who probably would want me to ask a question.
Sure.
How does it actually work? How do you get the money out of your home and give it to someone else?
Sure. Well, essentially what we have found is that by complying with the reverse mortgage regulation, we are able to make a lending decision based on assets rather than based on income surplus or employment status. So that's the key thing. But what we're doing a bit differently is most reverse mortgages and reverse mortgage providers are focused on people for whom their home is their only asset. And so they kind of need the money. And we thought, well, we can't solve everything, but let's focus on people who, if you like, want the money, who have lots of assets, but are struggling to access debt. And so we found as long as we comply, which means in a sense, it's fairly low loan to value ratio loans. And we set some hurdles around people needing to own their home and have significant other assets beyond the home, which gives us confidence that these are not people who are financially vulnerable. And so we've specifically designed our business around that. And once you meet those qualifications, the process is very easy. So the other thing that's happened over the last few years is the advances in technology, which has meant that our online application takes about 20 minutes to do. You do your digital identification, We use digital access to people's bank statements, all in a very secure, private environment. And all going well, we can literally grant a loan and fund it and have money in people's accounts same day if all goes well. Now, in most cases, it takes a bit longer than that because people need to upload copies of documents. And we have a video conversation with every customer to make sure that they're not vulnerable, that they understand the product, that this is appropriate for them, that they've thought about how they're going to pay it off, all those good things. But basically, we've taken the advances in technology, we've thought really carefully about who we're targeting here to make this available, and we think it's pretty cool.
Seems to work, right?
It seems to work.
How big? So what sort of LVR levels will you lend up to, or what the aggregate size of money that someone can extract?
So the maximum if you're 75 years old is 35%.
Okay.
And then it's down to 15% if you're 55. So our target market is people 55 to 75 who own their home. And the maximum loan size at the moment is $500,000.
Okay. That's a fair chunk of change.
Yeah, well, if you're sitting in a house worth $3 or $4 million, that's enough. We've sized it so it's enough to provide the down payment on most people's first home.
Yeah. Wow.
Yeah.
What a and I sort of want to understand the best way for young kids to approach it with their parents. We'll get into that in a moment. But is it safe to assume that, well, maybe you can have your experience so far, that the type of people who would consider taking on this particular facility, that they have a certain degree of wealth in order to be able to participate into it and not be at that point in time where they may be sort of stressed? Do most people have a sense of financial savviness to have got to the point where they've got significant amount of assets and stuff? It's an easy conversation to have.
It's a pretty easy conversation.
Yeah.
I mean, we can't solve this for everyone. If we sense that somebody is really not sophisticated at all or doesn't have enough financial backing, then we will say, look, this is probably not for you. But they don't need to be hugely sophisticated. We're not, because someone who's incredibly sophisticated probably has a private banker who can, find some fancy solution for them, and or maybe they've got it's all through some kind of corporate entity or whatever. But we're talking. Our customers are retired. We have retired architects. We've got a lot of women who've been perhaps divorced and they've inherited some things, but they'd like to do some other things and want some flexibility, don't have a permanent job, and so the banks aren't interested. I'd say it's a lot of people who, in their mind, are frustrated because they're saying, hang on, I've got a lot of assets, but the bank doesn't want to know me. The bank isn't interested. The bank has told me to go away, and that just seems wrong. And, those are the sort of people that we often
you think about, it's the supporting lifestyle choices for those people. It's going to give them a lot of capacity. Do you have any do you ask for the reason of using money, or do you need to give a sort of sense of purpose for it?
But I mean, effectively, they can use the money for any legitimate purpose. We do ask, but mostly through the context of wanting to understand and make sure that they understand what they're doing and why they're doing it and that they've thought about it. But we've got people who have wanted to subdivide some land that they own to give a property to each of their 3 kids and give them some money to then develop that for themselves. Wow. We've got people who've wanted to use the money to help their kids with their first home. We've got people who've talked about taking the trip of a lifetime. I mean, it really can be whatever they want to do.
Yeah, it's enabling retirement, really.
It's enabling a great lifestyle and better choices for the family overall.
Yeah. And where would the risk lie? And as a banker, you're probably very comfortable with risk discussions.
Yeah.
Yeah.
Look, I think from a traditional credit risk perspective, there's very little from our standpoint, almost at all. I think the risk is more that we accidentally lend to someone who this doesn't suit. And so most of our effort has gone into designing the conversation with the customer to make sure that we understand where they're coming from, why they want to do it, that they actually making sure they understand it, that they've thought about how they're going to pay it off, that they understand the product. And so the risk is more in that, is in inadvertently lending the money to someone that this isn't appropriate for. And that's really where we spend a lot of our time.
Yeah, it sounds like you've created a pretty robust triage process to make sure you get that right.
Yeah, we have a structured conversation, and it is just a conversation really, but we make sure that they understand the product, that we want to understand their situation, we want to understand their family situation. We want to make sure there's not some hairy biker son-in-law that's, making them do it. So we want to make sure that if it's a couple, we want to make sure that both people in the couple understand it, and that we're very alert to elder abuse, spousal abuse, all these sorts of things.
Yeah, wow, yeah. Well, it's all there, and you have sort of the prudent way of approaching it. That way means that you obviously, we spoke about banks like lending money. You're in a business lending money for a particular purpose, and I can see the solving solution, but no doubt a lot of our listeners are going, that sounds great. How do I knock on my mum and dad's door and say, give me a few bucks? We'll have a chat about it. We'll just go to another break. Last break. Stay with us. Back in a moment.
Have you considered adding Perth property to your portfolio? Momentum Wealth has experts on the ground to help you find the best opportunities in WA. They'll take care of everything from shortlisting and inspecting properties right through to negotiating the best deal on your behalf. And when it comes to managing your property, they have experts for that too. Contact their award-winning team today at momentumwealth.com.au and get your advantage in Perth's property market.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with Brian Hartzer from 2B. He's the chairman. There was a really interesting new product. We're chatting about sort of the mechanics of the product, how it works and who it's for. It sounds pretty cool, but how do you actually approach your mum and dad and say, hey, look, I know you got all this equity. I'd really like to get started on the property market sooner rather than later. Can you help me out?
Yeah, well, it's interesting. We did some research recently, and a lot of people in this generation are afraid to ask their parents for help.
Yeah.
And it was very clear, and I think that's a good thing. You know, they want to stand on their own 2 feet. They don't want to pressure their parents. They respect that it's their parents' money. It's not their money. But on the other hand, when you ask the parents, something like 2/3 or over 60% of parents say that they would like to help their kids. So I think the starting point is, how do you feel about this? That there is everyone knows that, it's conventional wisdom that buying a house is the best investment that you can make. And so there is a conversation about, look, I want to stand on my own 2 feet. I want to pay a mortgage, but it's going to take me 10 years to get a deposit together. And if you're willing to help me with the deposit, I will take on the mortgage and be responsible. And there's a subtlety there. A lot of parents have been doing this through guarantees, right? Which is great in certain situations, but it also sets up this kind of interesting thing emotionally where if the kid gets into trouble, the parent's house is at risk. And that can be quite a fraught situation. So we have very deliberately set up our situation where our relationship is purely with the parent. And we will give recommendations, we will give educational information to the parents about how they might want to structure it, and we recommend that they document how they help their children. But it's really up to them to then think about how they want to help the children. And so I guess we will certainly be alert to kids pressuring their parents. We certainly don't think that's appropriate. But we also know that there are a lot of parents, not all, there are plenty of parents who say, no, I don't want to help my kids. I did it myself. They should do it themselves. And that's absolutely fair enough. But we do know that 60% of parents would like to help their kids. So, maybe it's just a simple conversation. Is that something you'd consider? Yeah,
well, 60% is a big number, and it's really funny, Brian. I sometimes get feedback from parents saying, thanks, Phil. I've had my kids sort of trying to tap me up to get into my equity, and it's been a really good experience for them. So for those of you who don't want to ask your parents, I'm happy to ask for you. Hey, if you want to help your kids out, this might be the product that gets you there. But it sounds to me it's all about the education, right? People need to be comfortable with the process, and that's a big focus for you moving forward. How do you democratize this idea? It's been around, it's been happening for as long as probably there's been houses around Australia, but to actually put some structure around it.
Well, the other thing is it's been happening. If you go to the very, very top end of the tree, if you got some millionaire who's got tons of money and owns lots of properties, and I've met people who've gone and bought houses for their kids. God bless them. But for a lot of people, they don't have that option, and hopefully this is a way that actually maybe more people will get the option to help their kids who might like to, but otherwise don't have the resources to do it.
Yeah. Well, we all know, and we've spoken about it, and you just need to go and look at it, the getting into the market early if you are a buyer, whether you're an owner, occupier, or a property investor, the sooner you get in, largely the better off you'll be if you have the right financial circumstance, all that sort of stuff. But I've been sort of socialising what you're doing with the sort of property profession, so people that work within it, like mortgage brokers and buyer's agent. I'm sort of chatting to mortgage brokers, saying, hey, this exists. And they're like, oh, okay. And what's resonated for them, and we have a lot of mortgage brokers listen to this, is that, that's good that they can extract some equity in their home and deploy it in the property, but the mortgage broker actually then needs to help the buyer sort out their home loan, and so it just brings it into the family, brings it really tight. And I guess in the best case scenario, or the ideal case scenario, is that you help your kid into a property that goes in value. You refinance at a point in time, you pay back mum and dad.
Absolutely.
And you're on your way.
Yeah, that's plan
really
A. That's plan A.
Yeah.
And to your point, we've seen some real interest from the mortgage broking community because you get someone shows up and says, look, I want to buy a house. I can afford a mortgage, but I don't have the deposit. And so in those situations, well, here's a new option that might mean that the broker can actually help the first home buyer if the parents are willing to help the buyer.
Well, the big thing for me also is buyer's agents who really engage with the area, where they just, like, one in particular, he's a regular guest on this show, he's saying, I reckon, I don't know exact number, multiple tens of % of people, first-time investors going, I want to buy a property, can you help me out? And he's like, well, you need a deposit. Well, I can't get one.
Right.
Speak to mum and dad.
Right.
That's the way to go.
Yeah.
Right.
Yeah. Well,
a lot of relevance there.
Yeah.
Well, keep at it. I look forward to watching this.
Thanks. Thank you.
This go. What's sort of 3 years going to look like ahead for 2B? Any bold, ambitious plans?
Yeah. Well, we'd like to really make this something that people see as a new category that's available. It's a huge potential market. There's at least a million Australians that probably would qualify for this if they want to get into it. So we'd like to see some real traction and open this up as a new option. And then we'd like to start to expand the product in different ways. We'd like to look at a line of credit product down the road and maybe even a longer term loan. We're doing a 5-year loan at the moment. If we get the right funding partners behind us, we may be able to offer loans with longer terms than that. We've had some interest in expanding into New Zealand. So there's some geographic options for us. This baby boomer phenomenon, this exact same issue exists in New Zealand. It exists in Canada. It exists in the UK. It exists in the US. So, we'll see. But
see how it goes.
We'll see how it goes.
Yeah, well, nice one. Well, thanks for coming in and tell us all
Thanks
about
for
it.
having me. Really appreciate it. Great to chat.
Yeah, nice one. Brian Hart's chairman of 2B. Just so I got my language right, so when I refer to this sort of stuff we're talking about, it's a growing category. It's a home equity loan. Is that right?
It's a home equity loan. It's essentially a home equity loan. Yeah.
Okay. All right. I'll make sure I get my words right.
Home equity loan for people over 55.
There you go. Simple. Yeah, we'll follow this business, see how it goes. Go and check it out. Obviously, you read more about this on smartpropertyinvestment.com.au. Social media, where Smart Property HQ is where you find us. I hope you like what we're doing with this. We're getting a lot of really good feedback around it. And anything specific around this, we're going to do a Q&A episode soon, because I'm getting a lot of people asking me questions around what should they do in this current market and all this sort of stuff. So we'll get some people in. We'll have a bit of a yarn about it, but I'm happy to answer any questions around this. And if I can't answer it, I'll point you down the right way. How do people find out about you guys? Just go to your website.
Oh, really simple. www.2be.com.au. The number 2be.com.au.
Okay. Start there. That's probably the best spot. Thanks, everyone. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Would you like the latest news and insights in HR, leadership and people management? HR Leader has you covered. Subscribe at hrleader.com.au.